Ever wondered how much money you need to kick back and live off your dividends? Think about the financial freedom that comes with the steady dividend income. No more worrying about bills, just enjoying the fruits of your investments. But just when you think you've got it all figured out, here comes Uncle Sam, ready to take a chunk of your earnings through taxes. In this video, we'll help you navigate the complexities of living off dividends by showing you exactly how much you need to invest, taxes included. I'll simplify the concepts, break down the numbers, and offer actionable tips to maximize your after-tax income. In the end, I will show you a portfolio that can turn a $10,000 investment into over $700,000 and pay $40,000 in annual tax-free dividends. Overview of dividend investing. Dividends are portions of a company's earnings distributed to shareholders, and they can be a good source of passive income. When a company earns profits, it has a few options: reinvest the earnings into business, pay down debt, or distribute the earnings to shareholders in the form of dividends. Dividend investing involves buying stocks of companies that regularly pay dividends, which can provide a steady income stream over time. This form of investing is particularly appealing because it's considered one of the most passive ways to earn money. You invest in stable, dividend-paying companies and enjoy the income without the need for constant buying and selling. Historically, dividends have been a stable and reliable source of returns. For instance, if we look at the S&P 500, the dividend growth has been remarkable. From 1900 to 2018, dividends have grown steadily, often outpacing inflation. According to Fidelity, 54% of all market returns during high inflation periods have been associated with dividends. This shows that dividends can play a crucial role in the investment strategy, especially when inflation is high, providing consistent income with relatively low volatility compared to stock price movements. But when it comes to dividends, understanding the difference between qualified and non-qualified dividends is crucial for effective tax planning. Qualified dividends are regular dividend payments from a corporation that meets specific IRS criteria and are taxed at a lower long-term capital gains tax rates, which are 0%, 15%, or 20%, depending on your income. These dividends come from U.S. corporations or qualified foreign corporations, and the stock must be held for a certain period. For example, dividends from companies like Coca-Cola and Chevron are often qualified dividends, making them more tax efficient. Non-qualified dividends, on the other hand, are taxed at your regular income tax, which can be significantly higher. These are also known as ordinary dividends and include dividends from real estate investment trusts, or REITs, master limited partnerships, MLPs, and certain other investments like covered call ETFs. For instance, dividends from REITs can be enticing due to their high yields, but the tax implications are less favorable since they don't meet the IRS's qualifications for lower tax rates. The IRS has specific requirements for dividends to be considered qualified. The stock must be held for more than 60 days during the 121-day period that begins 60 days before the ex-dividend date. This holding period is crucial because it ensures that investors don't just buy the stock to capture the dividend and then sell it immediately. Meeting these requirements can make a significant difference in your after-tax income. To simplify it, let's consider two scenarios. In one, you receive $40,000 in annual dividends, and in the other, you receive $60,000 in annual dividends. Suppose you receive $40,000 in dividends. If these are qualified dividends, they fall into the 0% tax bracket for qualified dividends, which applies to incomes up to $47,025. Therefore, you would owe $0 in taxes, leaving you with the full $40,000. However, if these were non-qualified dividends, they fall into the 12% tax bracket for ordinary income, which applies to incomes between $11,600 and $47,150. You would owe $4,800 in taxes, leaving you with $35,200. The difference in after-tax income between qualified and non-qualified dividends in this case is $4,800. Now, let's consider a different scenario where you receive $60,000 in dividends. If these are qualified dividends, they fall into the 15% tax bracket for qualified dividends, which applies to incomes between $47,026 and $518,900. In this case, you would owe $9,000 in taxes, leaving you with $51,000. On the other hand, if these were non-qualified dividends, they fall into the 22% tax bracket for ordinary income, which applies to incomes between $47,150 and $100,525. You would owe $13,200 in taxes, leaving you with $46,800. The difference in after-tax income between qualified and non-qualified dividends in this scenario is $4,200. In the end, I will show you a portfolio that can turn one $10,000 investment into over $700,000 and pay $40,000 in annual tax-free dividends. In addition to understanding the types of dividends, it's also important to consider your overall investment strategy. For instance, holding dividend-paying stocks in tax-advantaged accounts like Roth IRAs or 401ks can help mitigate the tax impact. Which brings us to our next chapter. That is, strategies to minimize tax obligations. Minimizing tax obligations on your dividend income can maximize your after-tax returns. One effective approach is using tax-advantaged accounts like Roth IRAs and 401ks. In a Roth IRA, your investment growth is tax-free, and withdrawals and retirement are also tax-free, allowing you to enjoy your dividends without the tax bite. Traditional IRAs or 401ks let you defer taxes until withdrawal, potentially lowering your tax burden during peak earning years. Let's look at an example. Suppose you invest $100,000 in a dividend-paying stock that yields 4% annually, providing you with $4,000 in dividends each year. If you hold these stocks in a taxable account and these dividends are non-qualified, they will be taxed at your ordinary income tax. For a single filer with an income of $60,000, this places you in the 22% tax bracket. You would owe $4,000 times 22%, which equals $880 in taxes each year on these dividends, reducing your after-tax dividend income to $3,120. Now, let's consider if you hold the same investment in a Roth IRA. In a Roth IRA, your investments grow tax-free, and you won't owe any taxes on withdrawals in retirement. This means you keep the full $4,000 in dividends each year without any tax deductions. Over time, this tax-free growth can significantly enhance your wealth accumulation. For example, over 20 years, assuming the dividends are reinvested, your investment could grow substantially more compared to holding it in a taxable account, thanks to the compounding effect without tax drag. Similarly, if you hold the investment in a traditional IRA or 401k, you defer taxes until you withdraw the funds in retirement. Suppose you are in a lower tax bracket in retirement, say 12%. When you withdraw the $4,000 in dividends, you would owe $4,000 times 12%, which equals $480 in taxes, allowing you to keep $3,520. This is still better than the $3,120 you would keep if you held the investment in a taxable account during your peak earning years. Focusing on long-term holding is another key strategy. By holding your dividend-paying stocks for over 60 days during the 121-day period starting 60 days before the ex-dividend date, your dividends become qualified and taxed at lower long-term capital gains rates. This significantly boosts your after-tax income. Now that you know how dividends are taxed, how much do you need to retire, taking into account all the tax considerations and tax brackets? Let's say you have 30 years to retire now, and you create a portfolio of these stocks. Your portfolio metrics will be portfolio current dividend yield of 2.36%, portfolio dividend growth rate of 15.02%, portfolio share price appreciation of 11.75%. Based on these metrics, if you invest $10,000 in this portfolio, here's what the future projections will look like. After 1 year, your investment will be valued at $11,411. By the end of the first decade, the investment would grow to $38,694. Looking further ahead, the projection for the 20-year mark estimates the portfolio's growth to $163,884. This substantial increase is primarily due to the reinvestment of dividends and the capital gains accrued over the period. By the 30-year mark, the portfolio is expected to reach an impressive $785,242. The dividends after 30 years are projected at $40,013, yielding a significant monthly dividend of approximately $3,334. The total value added to the investment over time from the capital appreciation and total dividend reinvestment stands at $542,126 and $233,116, respectively. Considering the tax implications for a single filer, since these dividends meet the IRS criteria for qualified dividends, they fall into different tax brackets over time. For example, after 1 year with $236 in dividends, the amount falls into the 0% tax bracket for qualified dividends, $0 to $47,025, resulting in no taxes owed. After 10 years, with $1,062 in annual dividends, this also falls in the 0% tax bracket, leaving the dividends untaxed. By the 20-year mark, with $6,139 in annual dividends, the amount still falls into the 0% tax bracket, resulting in no taxes owed. After 30 years, with $40,013 in annual dividends, this too remains within the 0% tax bracket for qualified dividends. If you invest $20,000 in the portfolio, it will be valued at $1,570,485 in 30 years at retirement. This will generate $80,027 in annual dividends or $6,669 in monthly dividends. Considering the tax implications for a single filer, after 1 year with $472 in dividends, the amount falls into the 0% tax bracket for qualified dividends, $0 to $47,025, resulting in no taxes owed. After 10 years, with $2,123 in annual dividends, this also falls in the 0% tax bracket, leaving the dividends untaxed. By the 20-year mark, with $12,279 in annual dividends, the amount still falls into the 0% tax bracket, resulting in no taxes owed. After 30 years, with $80,027 in annual dividends, this falls into the 15% tax bracket for qualified dividends, $47,026 to $518,900, resulting in $12,004 owed in taxes and leaving you with $68,023 after taxes, or a monthly income of $5,668. However, if these investments are held in tax-advantaged accounts like Roth IRAs, the benefits are significant. In a Roth IRA, your investments grow tax-free, and withdrawals in retirement are tax-free, meaning you keep the full amount of $1,570,485 after 30 years, without owing any taxes on the dividends or the capital gains. The best time to take advantage of tax-free accounts like Roth IRAs is as early as possible in your investment journey. By investing in a Roth IRA early, you allow more time for your investment to grow tax-free, significantly enhancing your wealth accumulation over the long term. This strategy is especially beneficial when your income is lower, as you can contribute to your Roth IRA at a lower tax rate, and then enjoy tax-free withdrawals when you are likely in a higher tax bracket during retirement. The longer your investments have to grow tax-free, the more substantial the compounding benefits will be, making early and consistent contributions to a Roth IRA an excellent strategy for maximizing your after-tax returns and supporting long-term financial goals. Want to know how to turn a one-time $25,000 investment into over $10 million that pays $10,000 every month? Click the video on the screen to find out.